Your asset allocation strategy. What is it? Why is it important? And how do we figure out what it should be? In this video, we'll get into all that and more. And stay tuned to the end of the video where we'll look inside my portfolio and see what my exact asset allocation is right now. What's up everyone? I hope you're doing well. Welcome back to the channel. If it's your first time here, my name is Jay, and on this channel, I give you the tools, the tips, and the tricks you need to manage your money and grow your net worth. So if that's something you're into, and why wouldn't it be, please consider subscribing down below. So right off the bat, what is your asset allocation? Your asset allocation is basically a fancy way of saying, how is your portfolio invested? How are you broken up between stocks, bonds, and cash, depending on how much risk you're comfortable with? Now, everyone needs a different asset allocation because we're all individuals. It doesn't make sense for everybody to be invested exactly the same way. We're all different ages at different stages of our life. We all have different goals for our money, what we're investing for, and we can all tolerate different levels of risk. Some people may not bat an eyelash when their portfolio drops by 40%. Other people may bring on night sweats and they might lose sleep for a week. That's why everyone needs to come up with their own asset allocation strategy. So when we're investing, risk and return is usually correlated. The riskier an investment is, the higher the potential return. When we look at our investment portfolio, stocks are usually on the riskier end of the spectrum. That's because there's no guarantee of any return on the capital you invest in a stock. If the company goes bankrupt, common stockholders are the absolute last people to get anything back. But when you compare stocks against bonds and cash, you also have the highest rate of return. Now with fixed income products, or bonds, you have a guaranteed return on your investment. When you purchase a bond, it'll say right up front what the percentage interest rate it'll pay you upon maturity. Bonds also have very little fluctuation in price, so there's very little risk of it dropping to zero and you losing all your money. However, the risk in bonds comes that you are locked into that interest rate. So if interest rates skyrocket after that and new bonds are yielding 5–10% more, the money you invest in that bond is locked in at that lower interest rate. So the opportunity cost there is a big risk of bonds. That's why in order to compensate, the longer the term of the bond, the higher interest rate it'll yield. That's because investors want a greater return on their investment to compensate for the risk of their money being locked up for that longer term and the fluctuations in interest rate that could happen during that time span. And finally, we have cash. Cash is going to maintain its value regardless of the market condition, but generally you're going to get a very low yield on your cash. Savings accounts, CDs, the interest rates are all very low in comparison to other investment products. And that's because the only true risk of holding cash is inflation. If you stuff all your cash in the mattress and you're not earning any interest rate, you're actually losing value because every year the inflation rate grows very slowly and the buying power of that cash diminishes. So why is our asset allocation strategy so important? For starters, it's the single most important factor in determining how our portfolio performs over the long term. Different asset types that we may be invested in will increase while others are decreasing. So what we try to do is come up with a good mix of those to balance out that risk, so we're getting a good balance of risk and return regardless of what's going on in the market at that time. The thing is, it's really important to stick to your asset allocation strategy regardless of what's going on in the market. If you come up with, say, a 60-40 split between stocks and bonds, but we're in a great bull market and stocks are going through the roof, if you start to get fidgety and antsy and say, oh, well, I'm losing out on all these gains in stocks because I have this portion in bonds, so you sell off all your bonds and throw it into the stock market and now you're 100% stocks, 0% bonds, that may be great, but as soon as the market turns, you're in for a world of hurt. Same thing is true in a down market. If you take that same portfolio, that's 60% stocks and 40% bonds, except this time we're in a deep recession and stock prices are falling through the roof, you can't panic and sell off all your stocks while the values are at the bottom to throw them in bonds. You've got to stick to that strategy that kind of balances out the risk between the top and the bottom. So how do we determine our asset allocation? The first thing we have to do is determine our risk tolerance. And the best way to do that is through honest reflection. How would you react if your investment portfolio lost 50% of its value over the next 2 weeks? There's panic in the media, the world is ending, this time is different, all that is in the news. Are you going to stay the course, or are you going to panic? Now, if you've been investing for a while, you can look back at your past history and see how you've reacted. When the markets dropped this past March due to the COVID-19 scare, how did you react? When the financial crisis hit in 2007, 2008, and stocks plummeted, how did you react? How did you react in any of the previous recessions before that if you've been investing that long? This is one case where past performance does predict future results. Now, if you meet with a broker or a financial advisor, they'll usually give you some sort of little quiz or questionnaire where you fill out a bunch of questions on how you react to different scenarios, and they'll determine your risk appetite that way. The problem with those is people usually overestimate their appetite for risk and overestimate how they'll respond in certain situations when it's just a question on a piece of paper versus a real life scenario. Now, if you want to try out some quizzes like this or questionnaires, I'll link to a few down in the comments below, so go check those out and see what kind of results you get. Once you have a good idea of what your risk appetite may be, we can use that to now determine the breakdown of our asset allocation for our investments. A general rule of thumb is to take your age and subtract it from 110, and this will give you the percentage of your portfolio that should be invested in stocks. So if you're 30 years old, subtract 30 from 110 and you get 80. That means you should have 80% in stocks and 20% in bonds. Now, the theory behind this is the younger you are, the more risk you can afford to take on, because if the market crashes and you lose 50% of your investment portfolio, you have plenty of time to wait and let things recover. Whereas if you're 60 and you want to retire in the next year or two, you can't afford to take those risks. You need to be more on the conservative end of things, so you're protecting your money instead of focusing more on growing it. Now, the problem with a calculation like this is it's just a rule of thumb. It assumes everybody is the same. Now, not every 30-year-old is going to be comfortable with an 80-20 split between stocks and bonds. Like I mentioned earlier, we all have different appetites for risk and we all have different goals for our money. So really, it's just a good starting point to get an initial number and then tweak it to your individual situation from there. Now, Benjamin Graham, author of The Intelligent Investor, which for my money is the Bible for any investor, advises you start with a 50-50 split between stocks and bonds and work your way up to a 75-25 split in either direction. Now, if you ask me, a 75-25 split may be a tad too conservative for younger people, but again, we're all different. We all have different levels of risk that we have for our money, so again, it's just another guideline. Another helpful tool is this risk appetite chart, which I'll put on the screen right now. What you do is you take the percentage that you're comfortable with losing at any one time, and the chart will show you which asset allocation most closely lines up with that level of risk. So if I'm comfortable with losing 30% of my investments at any one time, like that's the kind of drop that's not going to freak me out, I'll look at 30%, go over and see which asset allocation that recommends and go from there. Now, once you come up with the numbers for your asset allocation strategy, it's important to know it's not set in stone. You can and absolutely should tweak and change it according to life events, age, and different time horizons of your financial goals. So now that we have our numbers, our breakdown of what our asset allocation should be, how do we implement that strategy? For beginners, I would take the amount of money that you have to invest and split it between some broad index funds. Now, I like to stick to Vanguard ETFs with my investments, so I'll be using those for my example, but you can absolutely use any mutual funds or ETFs from any broker that you're comfortable with. If my asset allocation strategy came out to 80% stocks and 20% bonds, what I would do is take that 80% for the stocks and find a total stock market fund for the stock portion of my portfolio and invest that 80% in there. And the same thing for the bond portion, that 20%. I would find a total bond market fund and use that for the 20% of my portfolio. If you want to take it a step further, you can split that stock portion between US and international. That's what I do with my portfolio. I have a total US stock market fund and a total international stock market fund, and I split my stock investment between those. For the bonds, I keep it simple. I stick to one bond fund and just throw everything in there, and that's how I do it. But whatever you're most comfortable with, that's the strategy for you. Now, as you become more comfortable with investing, you can add in different asset classes, things like real estate, or maybe gold or silver, or even cryptocurrency. But again, for beginners, I would just stick to broad index funds for stocks and bonds and leave it at that. Now, before we get into my investments, please take a minute, smash that like button down below, tell the YouTube algorithm that this video is worth showing to other people. Leave me a comment, let me know what your asset allocation is, how you're split between stocks and bonds and whatever else you invest in. And please take a minute, if you like the channel, subscribe. I have a new video that comes out every week and I don't want you to miss it. Okay, so now let's get into my portfolio and how it looks and how it compares to my targeted asset allocation. Right now, 71% of my total investment portfolio is in stocks. And to break that down further, within that, we're split about 76-24 between that US fund and international fund I talked about a second ago. Now I have 12.5% in bonds, which as I mentioned earlier, is all in one broad market bond index fund. Roughly 7% of my portfolio is in real estate. Now I don't own any investment properties or any land or anything like that. But how I invest in real estate is through an ETF that holds real estate investment trusts. Basically, they're companies that hold real estate all across the country or the world. They're large companies that own housing projects or malls and movie theaters and things like that. So rather than buying individual properties on my own, that's how I chose to get my exposure to the real estate market. And finally, I have just under 10% of my investment portfolio sitting in cash, waiting to be put to work. So how does that stack up against the asset allocation I'm targeting? It's actually pretty close, and I'm kind of happy with that. Ideally, I'm targeting to have about 75% of my investments in stocks, about 15% in bonds, 5% in real estate, and 5% in cash. You always want some cash on hand so you can put your money to work when you need. So now that we see I'm a little off of my targets, or maybe you are way off of your targets, what do we do in that case? What I like to do is once or twice a year, I'll go in and I'll rebalance my portfolio. Usually I like to do it in the middle of the year, June, July, and then again at the end of the year around December. So in this case, since I do have like 10% of my investments sitting in cash, what I'll do is I'll invest that cash into the investment classes that are underweight currently to try to bring those up to the targeted percentage. So in this case, I'd be buying more of the stocks and a little bit more of the bonds. I'd be leaving real estate alone because that's a little high for me right now. And obviously, as I invest that cash, it'll bring my cash balance down towards that target. So that's what I would do, say, if I were to go rebalance today. Now, if I found myself way out of whack and I didn't have enough cash sitting around to even things out on its own, I'd have to sell some of my investments that were way overweight and invest it in the ones that are underweight. Now, that's not necessarily a bad thing, because how that may happen is, say, stocks went on a huge run. So stocks gained a lot, and that you went from 70% invested in stocks, but because the stock market went up so much, now you're around 85% in stocks. So you sell off a portion of those and put it in your bonds or whatever else to bring your stocks back down to 70% and bring those levels up. And that essentially is how to come up with your asset allocation, how to invest it, and how to rebalance it. If you have any further questions, please let me know in the comments. If you liked this video and you found it helpful, please subscribe to the channel. You can hit my face on the next screen if that makes you feel good. That's it for me, and I'll see you in the next video. You're guaranteed a return. It'll tell you the percentage of return on that. So I just recorded the whole second half to my video and I didn't press record on the camera.